Your parents own a house, have some retirement savings, and have never mentioned a will, a trust, or a single piece of paper that explains what happens to any of it. This is not a rare situation. It is the default for most regular families, and the cost of that silence is not measured in estate taxes because most families never get close to the thresholds where that matters. The real cost shows up in probate delays, confused beneficiary designations, and family conflict that could have been avoided entirely with a handful of specific, accessible legal tools. Here is exactly what regular families, not ultra-wealthy ones, should actually be doing. Welcome to Daily Money Mindset. Let us clear up the biggest misconception immediately. Most wealth transfer planning content online is written for households with multi-million-dollar estates worried about federal estate tax, which currently only applies above a threshold in the tens of millions of dollars for a couple. If that is not your situation, and it is not for the overwhelming majority of families, the strategies that actually matter to you look completely different, and they are far more accessible than most people assume. The first tool every regular family should understand is beneficiary designation optimization. Retirement accounts, life insurance policies, and many bank and investment accounts allow you to name a beneficiary directly, and these designations override whatever a will says entirely. This means an account with an outdated or missing beneficiary designation can end up going to an ex-spouse, an estranged relative, or simply through a much slower probate process, regardless of what your will or your stated wishes say. The action here is straightforward and takes less than an hour. Pull up every retirement account, life insurance policy, and bank account with a beneficiary option, and confirm the designation is current and intentional. This single task, done once and reviewed every few years or after major life events, prevents some of the most common and painful wealth transfer mistakes. The second tool is the transfer-on-death and payable-on-death designation, which most people have never heard of, despite it being available on most standard bank and brokerage accounts at no cost. Adding a transfer-on-death designation to a bank account or a payable-on-death designation to a brokerage account means that account passes directly to the named person upon death, bypassing probate entirely, without needing a trust or any complex legal structure. For many regular families, simply adding these designations to existing accounts accomplishes much of what people assume requires an expensive trust. The third tool is gifting, and the relevant detail for regular families is the annual gift tax exclusion, which allows any individual to give a meaningful amount of money to any other individual each year without any tax filing requirement or impact on lifetime exemption amounts. For a family wanting to help an adult child with a down payment, fund a grandchild's education, or simply transfer wealth gradually rather than all at once through inheritance, understanding and using this annual exclusion strategically can transfer substantial value over time with zero tax complexity, as long as you stay within the annual limit per recipient. The fourth tool, increasingly relevant in 2026, is the revocable living trust, which deserves a more nuanced explanation than the simplified version often presented online. A revocable trust does not reduce estate taxes for most regular families, since most families are nowhere near the relevant threshold. What it actually does is avoid probate, which can be a slow, public, and sometimes costly court process, and it provides a mechanism for managing assets if the account holder becomes incapacitated before death, not just after. The decision about whether a revocable trust is worth the upfront cost, typically a few $1,000s to set up properly with an attorney, depends heavily on your state's probate process and the complexity of your assets. States with slow, expensive, or particularly public probate processes make a trust more valuable. States with simplified probate procedures for smaller estates may make a trust unnecessary for many regular families. This is worth a direct conversation with an estate attorney in your specific state, rather than assuming either that you definitely need one or definitely do not. because the answer genuinely varies by location. The fifth tool is a properly drafted will combined with a clearly designated power of attorney and healthcare directive, which together form the baseline documentation every adult should have regardless of asset level. The will directs what happens to assets not covered by beneficiary designations or trusts. The power of attorney designates who can make financial decisions on your behalf if you become incapacitated. The healthcare directive specifies your medical wishes and designates who can make healthcare decisions if you cannot communicate them yourself. The absence of these documents, more than the absence of sophisticated tax strategy, is what causes the most genuine hardship for regular families during a crisis, because without them, family members may need to go through court proceedings just to make basic decisions during an already difficult time. Now let us talk about the family conversation dimension, because the legal tools only work well if the family understands and accepts them. The most common source of family conflict during wealth transfer is not the actual distribution of assets. It is surprise. A sibling discovering they were named executor without being asked. A family member learning about a specific bequest only after a parent's death. Or unequal distributions between children that were never explained while the parent was alive to provide context. Having a direct conversation, even a brief one, about the existence and general content of your estate plan prevents the vast majority of the conflict that estate disputes are actually built from. This does not require sharing exact dollar figures if that feels uncomfortable. It requires sharing enough structural information that nobody in the family is blindsided. Who is the executor? Where are the documents located? Are there any specific instructions or unequal distributions that deserve context while you are still able to explain your reasoning directly? Families who have this conversation, even imperfectly, overwhelmingly report smoother transitions than families who avoid it entirely and let the legal documents do all the communicating after the fact. Let us bring this together into a practical action checklist for a regular family in 2026. First, audit and update beneficiary designations on every applicable account. Second, add transfer on death or payable on death designations to accounts that support them. Third, understand the annual gift exclusion if you are considering helping family members financially during your lifetime rather than only through inheritance. Fourth, have a direct conversation with an estate attorney in your state about whether a revocable trust makes sense given your state's probate process and your asset complexity. Fifth, ensure you have a current will, power of attorney, and healthcare directive, regardless of how modest your assets are. Sixth, have the family conversation about the structure of your plan before it becomes necessary rather than after. None of this requires the complexity or cost that most wealth transfer content assumes. It requires a handful of specific, accessible actions that regular families consistently skip, not because the actions are difficult, but because nobody frames this kind of planning as relevant to anyone outside the ultra-wealthy. If this gave you a clearer next step for your own family's planning, hit the like button and subscribe to Daily Money Mindset for 3 videos every week on practical financial strategy. Drop a comment below and tell us which of these tools you had never heard of before this video. We read every comment. Resources for finding an estate attorney in your state are linked in the description below.